Hello everyone, my name is Wang Lijun. I'm an INT student. Our group assessment is about a company. There are some facts, issues, and decisions and arguments about our group assessment. First of all, the facts of this company is the taxpayer, a limited company, incorporated on 30 December 1964, acquired certain pieces of land. On January 1965, lot number 1131 was later sub-CPA Tax Investment Review 2003 232 divided into various commercial and residential properties and recognized as current assets in the company's report and accounts. However, in 1980, when the company submit its proposal to be listed on Kuala Lumpur Stock Exchange, some of the commercial properties were revalued and described as fixed assets held for long-term investment. In mid-1980, a director's resolution was passed to reclassify the subject loss as fixed assets retrospectively from 1978. On 7 November 1980, the taxpayer was converted to a public company. In 1980, the taxpayer started to dispose of its fixed assets. The profits on the sale of the subject lost and the interest received on the last payment of proceeds were assessed to income tax. Our issues is, first of all, whether the proceeds on the sale of subject loss were chargeable under the Real Property Gains Tax Act 1976 or Section 4A of the ITA. And the second issue is whether the related interest income received from the late payment of proceeds is capital receipts or business income and therefore chargeable to tax. And there are some arguments. First, taxpayer. The subject loss were held as capital assets. Therefore, the sales proceeds are not subject to income tax but real property gains tax. As such, the interest income received on the late payment of the sales proceeds is a capital receipt and not chargeable to tax. And IRB, the subject loss are stock in trade and therefore the proceeds of their disposal is subject to income tax. Consequently, the interest income received on late payment of sales proceeds is also subject to income tax. Second, the retrospective effect on the director's resolution due to inadvertence was not valid for tax purposes. On the assumption that the director's resolution was valid in relation to the retrospective effect of the reclassification of subject loss to fixed assets from 1978, then there would be a transfer of assets from current assets to fixed assets. Subsequently, the provisions of Section 22 would need to be complied with. However, the provisions of Section 24.2 were not complied with by the taxpayer. As such, the reclassification of the subject loss from current assets to fixed assets was not recognized by the IRB. As such, the subject loss was still considered as current assets. Therefore, according to paragraph 26, Schedule 5 of ITA, the assessments are to be adapted by borrowing to tax